Welcome to our channel. In today's video, we're diving into one of the most important yet often overlooked aspects of cryptocurrency trading: volume. Whether you're a complete beginner or an experienced trader, understanding trading volume is crucial for success in this dynamic market. Think about it this way. Would you feel comfortable buying a house in a neighborhood where only one house sells every 5 years? Probably not. The same principle applies to cryptocurrency trading. You need to know how active the market is before making investment decisions. In the next 16 minutes, we're going to break down everything you need to know about trading volume in the cryptocurrency market. We'll explore why it matters, how to interpret it, and most importantly, how to use this knowledge to make better trading decisions. Before we dive in, take a quick second to hit that subscribe button and turn on notifications to stay updated with our latest crypto insights. Let's start with the basics. What exactly is trading volume? At its core, trading volume refers to the total amount of a cryptocurrency that's been traded during a specific time period. This could be measured in minutes, hours, days, or even months. For example, if Bitcoin's 24-hour trading volume is 500,000 BTC, this means that 500,000 Bitcoin have changed hands in the past day. Think of trading volume like the foot traffic in a shopping mall. A busy mall with lots of people buying and selling indicates a healthy retail environment. Similarly, high trading volume in a cryptocurrency suggests an active, healthy market where lots of traders are participating. Trading volume is typically measured in both cryptocurrency units and fiat currency value. For instance, you might see that Ethereum had a trading volume of both 2 million ETH and $4 billion USD in the past 24 hours. This dual measurement helps us understand both the quantity of coins being traded and their monetary value. Let's break this down with a real-world example. When Bitcoin's price is $50,000 with a 24-hour trading volume of 100,000 BTC and dollar volume of $5 billion, this tells us that in the past 24 hours, $5 billion worth of Bitcoin has been traded across all exchanges. Now let's explore why trading volume is crucial for crypto traders and investors. First, trading volume is a direct indicator of market interest and liquidity. High trading volume typically suggests significant interest in an asset and that you can easily buy or sell without causing dramatic price changes. Think of it like trying to sell a house in different markets. In a busy real estate market with lots of buyers and sellers, you're likely to get a fair market price. But in a quiet market with few transactions, you might have to accept a lower price to find a buyer quickly. Here's how trading volume affects your trading. First, through price discovery. Trading volume plays a crucial role in determining the fair price of an asset. When trading volume is high, the price you see is more likely to reflect the true market consensus. Next is market manipulation resistance. Higher trading volume makes it harder for large players to manipulate prices. When volume is low, a single large trade can significantly impact the price. Finally, there's market sentiment. Trading volume can help you gauge market sentiment. Rising prices with increasing volume often indicates strong bullish sentiment, while rising prices with declining volume might suggest a weakening trend. Let's explore how trading volume impacts price movements and its role in technical analysis. When trading volume is high, we typically see more stable price movements. This stability comes from having many market participants actively trading, creating what we call market depth, mirrors the market's ability to absorb large trades without significant price changes. Here's an example. If you want to buy $100,000 worth of a cryptocurrency in a market with $100 million daily volume, your trade represents just 0.1% of daily volume. However, the same trade in a market with $500,000 daily volume would represent 20%, potentially causing significant price impact. Let's look at key volume-price relationships. High volume plus price increase equals a strong uptrend. High volume plus price decrease equals a strong downtrend. Low volume plus price increase indicates a weak uptrend. Low volume plus price decrease shows a weak downtrend. Volume is particularly valuable in technical analysis because it helps confirm or reject price movements. Think of volume as the weight behind a price move. The higher the volume, the more significant and reliable the price movement typically is. Let's look at the essential tools for analyzing volume and understanding market liquidity. First is the volume moving average, or VMA, which smooths out daily volume fluctuations to help identify the overall trend in market activity. Next is the on-balance volume, or OBV, which combines price and volume into a single metric by adding volume on up days and subtracting it on down days. Then there's the accumulation/distribution line, which shows whether an asset is being accumulated or distributed by large players. Trading volume is closely tied to market liquidity, how easily you can convert an asset without causing significant price impact. High liquidity markets offer tighter bid-ask spreads, lower slippage on large trades, more stable prices, and faster trade execution. Here's how to apply this knowledge in your trading. Always check volume before entering a trade. Look for volume confirmation on breakouts. Be cautious of price movements on low volume. Use volume indicators alongside price analysis. Monitor volume patterns across different time frames. Remember, volume is one of the most powerful tools available to crypto traders. Never make trading decisions based on price action alone. Always consider volume as part of your analysis. Thanks for watching. If you found this valuable, don't forget to like and subscribe. Drop your questions in the comments below, and we'll see you in the next video.